Good day, learners. My name is Mr. Simbi, and welcome to today's accounting lesson. This lesson is brought to you by the Gauteng Department of Education in collaboration with Sci-Bono Discovery Center, and it is being broadcasted by the Pakama Research and Development Center. Today's lesson, we are going to focus on our company's financial statements. We are now going to begin our lesson, but as usual, you need to get your calculator. Make sure you have somewhere to write. Make sure you have your pen, pencil, and paper as well as we begin today's lesson. I'll be dealing mainly with the balance sheet, but I'm going to take you through the steps that we need to take before we get to the balance sheet. So if you guys are ready, we are going to begin now. My objectives today are very simple. I'm going to talk first about the classification of the balance sheet accounts. In other words, where does the balance sheet come from and everything that involves the balance sheet. I'm going to talk about that today. And you'd understand as well that the balance sheet is like a puzzle whereby we have different pieces that we come and join together, which are called notes. So I'm going to talk about the notes to the financial statements, which are used to prepare the balance sheet. All right. And then I will, in this lesson, deal as well with the correction of net profit after tax. How do we correct the net profit after tax? All right. And then I will touch on financial indicators as well. Okay. So if you have a challenge with financial indicators, please stay tuned. All right. So the first thing is to know what is a balance sheet. We're talking about the statement of financial position. So this is a financial statement. That is the first thing that we need to take care of, that the balance sheet is a financial statement. Okay, and it is usually prepared at the end of the accounting period. And an accounting period, by now you already know that we're talking about a financial year. We're talking 12 months. To show the financial position. So its main purpose is to show the financial position of a business. That is in terms of its assets, liabilities, as well as its equity. Now, there are three sections to the balance sheet, okay, which will be presented as follows. You're going to see as we talk first about the accounting equation. I think from grade 8, when you're doing EMS, in grade 9 as well, in grade 10 and in grade 11, you did do the accounting equation, which is broken down as your assets, okay, is equal to your owner's equity plus your liabilities. These are the three main sections that I'm going to spend much of my time today in order for you to understand exactly what is the balance sheet. All right. Now, the accounting equation will help us definitely to assess whether the business transactions are carried out as accurately as they should be. Now, learners, it is very important that you understand the classification further. Now, here I have brought it as a breakdown for you. That is, you will see first on your left-hand side, you have first your non-current assets, And remember, these are assets that exist for more than 12 months. They exist for more than one financial period. So under your non-current assets, you have your land and buildings, you have your vehicles, as well as your equipment. And then you also have what we call financial assets. And under financial assets, you have your fixed deposit, the investments to the company. You also have what we call current assets. So current assets, every time you hear the word current, you must think 12 months and less. All right. Current, in other words, these are assets that exist in the business for one financial period. And we have three under our current assets. We have first our inventory, which in most cases we talk of note number 4. But when we come to our non-current assets here, we're talking note number 3. And under our current assets, we are talking of inventory, which is our trading stock, as well as our consumable stores on hand. And these ones go to note number 4. And the next one is also what we call trade and other receivables. Now, under trade and other receivables, you'll find your debtors control. You will adjust for provision for bad debts, and then you are going to add also your accrued income. Your accrued income, this is income that we should have received, but have not yet received it. So it becomes a receivable in that regard. And also prepaid expenses. These are expenses that we have paid, but should not have paid. So we also have our prepaid expenses and our trade and other receivables. And we will find these in what we call note number 5. They'll appear in note number 5. And then SARS income tax, it depends on the final assessment at the end of the year, whether if we are owing SARS or SARS is owing us. But there are instances whereby we have paid more to SARS than our final tax assessment. Therefore, SARS owes us in that regard, and therefore you bring it to trade and other receivables. In other words, we can claim it from SARS. And then you have cash and cash equivalents. Now, under cash and cash equivalents, you will have your bank, your petty cash. I think in grade 10, you have also seen your cash float. Yes, even in grade 11. And then you also find that when a fixed deposit is maturing within the next 12 months, it comes and it forms part of our cash and cash equivalents. This is a fixed deposit which we will receive within the next 12 months. Okay. That means you have to understand the relationship between your fixed deposit here with this one here. All right. I'll explain it even when I explain the short-term loan. And for this, you will have note number 6. So these are things you should know from your head, from your fingertips as you're writing, that when I'm talking about tangible assets, note number 3. When I'm talking about my inventory, note number 4. When I'm talking about my trade and other receivables, note number 5. And when I talk about my cash and cash equivalents, it will be my note number 6. I want to come now to the last column, which we have here, where we have our shareholders' equity. Under equity, we have 2 main things that we're going to talk about, which I'm sure you were introduced to in grade 12 this year. The first one is your ordinary share capital. Your ordinary share capital, and here you open your note number 7. Now, at a point where I want to believe that we are all familiar with note number 7. And then there's another note which follows, which is note number 8. And with note number 8, this is now your retained income. After that, you're going to have what we call non-current liabilities. So the moment it is non-current, it means it exists for more than 12 months. It exists for more than one financial period. But the moment it is current, it exists for 12 months and less. So what we have here is a non-current liability, which is our loan. In other words, these are loans that the business has, and they exist for more than one financial period. The moment you have a loan and you're paying it for more than 12 months, 24 months, 36 months, if you're paying it for so many months, you will classify it as a non-current liability. And the last group, which I'm going to talk about, are current liabilities. What does that mean? These are liabilities that exist for 12 months and less. Current, remember what I said. And therefore, the first one here is your trade and other payables. All right. And then trade and other payables is your note number 9. Trade and other payables becomes note number 9. And then you will find that you're going to have your creditors control, your accrued expenses. These are expenses that we should have paid, but have not yet paid. So they become accrued. We still have to pay them. Hence, you find them under accrued expenses. And we have income received in advance. What does that mean? It means we have received income which we were not supposed to have received. In this regard, we are owing whoever is giving us the income in advance. And then you have SARS income tax. This applies now when we have paid less provisional payments to SARS, and then we, at the end of the year, are owing SARS. It becomes a liability in this case under your current liabilities. And then you have your shareholders for dividends. This will be your final dividends. I want you to take note of this. Remember, you have 2 types of dividends. You have your interim, the paid one. You have your final, the declared. The final is never paid during the financial year. It will only be paid in the next financial year. Okay, so it goes on to our current liabilities as shareholders for dividends. You're going to see in the balance sheet that I have prepared for you today. And then lastly, you have a short-term loan. The short-term loan, it simply means of the long-term loan, there are, however, payments that we're going to make within the next 12 months. So if there are any payments which are going to be made within the next 12 months, they cease to be long-term, then they become short-term. I'm going to show you with figures how this comes about. All right. And then lastly, I'm going to talk about bank overdraft. Bank overdraft is also a current liability. Now, one of the most important things about the balance sheet is the equity section of the balance sheet, the equity. All right. In grade 10, we dealt with the sole trader, the one-man business. Okay. He enjoys all the profits as well as all the risk. So in his equity, we had note number 7, which was the capital. That was in the grade 10. All right. When we moved to grade 11, which was last year, we were now introduced to partnership. Okay. And in the partnership, you remember we did note number 7 again, which was now involving all the partners that are in the business. But there was an addition to a new note, which we called the current account, which was note number 8. The combination of these two notes, note number 7 and note number 8, then made what we call the partner's equity. In other words, it's your 100,000 there plus the other 100,000 to give you your 200,000. In grade 12, in this year now, things are going to be a bit different. When you go to note number 7, we're now going to open what we call the ordinary share capital. It is because now we're dealing with shares. Okay, we already know what shares are. And we also have to open note number 7 for ordinary share capital. Now, you're going to see today, when you open note number 7, how easy this note is. The next aspect is retained income. Retained income. Retained income is note number 8. All right. You're going to see today again, we're going to open another retained income note. And a combination of these two now, in addition of these two, then gives us what we call our shareholders' equity. So I'm going to spend time explaining especially this last aspect here. I'm going to spend some time that you may understand exactly what we are talking about. Here's a simple format of the balance sheet. Okay, a simple format of the balance sheet. A balance sheet is split into two parts. Remember, it is your assets here, all right, which is equal. The first part here, it is your owner's equity, and then the last part is your liabilities. So, to complete the accounting equation, assets is equal to owner's equity plus liabilities. All right, I'm going to do figures with you so that you can clearly understand what I am talking about. Now, the bank overdraft must appear on the face of the balance sheet. That is very important, that when we have a bank overdraft, that overdraft must be shown on the face of the balance sheet. And then our trade and other creditors include SARS income tax, that is tax payable, as well as shareholders for dividends. Now, you're going to see as I'm going to continue with the presentation that you can include them in the trade and other payables depending on the demands of the question that you are given. But at times you're given enough lines for you to record them separately and then show them according to the demands of the examiner. So our main point is we have to meet the demands of the examiner. Okay. Now, the first part, as I said earlier on, it is our assets. And as you can see here, under our assets, we have our non-current assets, whereby we added these two, and we had our 4,980,000. And then we had our current assets, where we added the 3, which is your inventories, your receivables, as well as your cash and cash equivalents. When you add these 3, they will then give you the 1,820,000. When you have your total non-current assets, which is 4,980,000, and then you come and add your current assets, which is your 1,820,000. These two then, when you add them, are the ones that give us the 6,800,000, which is your total assets. Total assets. I want you to come with me and look at the equity and liability section. As I said earlier on, your equity, here's the total to give us that one. And this is very important. This is very important because once you understand how to get this 50,000, which is your short-term loan or current portion of loan, that is what we then bring down here. So in today's lesson, I want you to please stay put, and then you are going to benefit from today's lesson. Now, the 50,000 deducted from the long-term loan is recorded as a short-term loan. And then the short-term loans can be recorded separately if space is provided. But if no space is provided, you might as well include them under trade and other payables. All right. Now, I want us to do an activity. This is what I want you to do. I want you to grab a paper, pen, please. Let's start with figures. It says this is a business, Pubi Limited. You're provided with information for the financial year ended 28 February, the year 2021. And it says required, complete the following notes to the balance sheet. Ordinary share capital. This is my note number 7. Retained income, this will be my note number 8. So these are two things that they require from us. Okay, so we are going to start. We're going to hit the ground now, and then we see how this is going to turn out. Now, with the information that we're given, it reads and it says, you have authorized share capital of 2 million shares. All right. You have authorized share capital of 2 million shares. And it says on 1 March, you had 1 million shares that were in issue. 1 million shares that were in issue. In other words, at the beginning, you had 1 million. That means you're going to come here and you're going to get your 1 million shares. Here's your 1 million shares. 1 million ordinary shares at the beginning. And then it says interim dividends of 35 cents per share. Okay, we're not going to do with interim dividends at the moment. Let's see what comes next. It says new shares issued at a price of 5 rand per share. So there are new shares that are issued. We don't know. We're not given the number of shares here, but they are telling us that it is at 5 rand per share. So I'll come here, I'll put my 5 rand, and I wait for the next information. This is one thing with accounting. Do not crack your head. Follow the instructions of the examiner. Always read the information in the order it is given. Do not skip and go to the next one. Now, the next one then says 100,000 shares were repurchased at 25% above the average price. So we're going to repurchase here 100,000 shares. 100,000 shares are being repurchased. And then they say we're repurchasing them at 25% above the average price. And then these shares qualify for final dividend. In other words, when we are declaring final dividends, we need to consider these 100,000 shares. They must get the final dividends. The relevant entries have been made in this respect. And then it then says, note that on 28 February, very important here, that 80% of the shares were in issue. All right, 80% of the shares were in issue. And the final dividend of 10 cents per share was declared. So what they're telling us is, at the bottom here, at the end, the number of shares that we were having is 80%. 80% of what? Of our authorized. Now we understand that our authorized is 2 million. 2 million. And they're saying 80% were in issue. So what we want is 80%. And if you calculate 80% on your calculator, you will realize that you get 1,600,000. So I'm going to come here and I'm going to get my 1,600,000. Okay, so I have my 1,600,000. That is the number of shares that we had at the end. Now, in order for us now to get the ordinary shares issued, remember we want to find how many shares were issued. It is very simple. Remember, one of the things that we have to remember is to calculate what is known as your average price, to calculate your average price. And the simplest way to calculate your average price, you can consider what is at the bottom here. Okay, what is at the bottom? And at the bottom, you have your 8,960,000 here, and you have the number of shares, which is 1.6 million. So if you come and say 8,960,000, you divide it by your 1.6 million, you will get an average price. I want you to punch that in your calculator, and I believe on a calculator you're going to get an average price. And in your classes, you have been taught that whenever you are repurchasing shares, you're going to have the triangle, whereby on top it is your repurchase price, here it is your average price, and here it is your difference. So what we are looking for is the average price. So if you say 8,960,000, you divide it by 1.6 million, you should get 5 Rand 60. Okay, so our average price becomes 5 Rand 60. Now we're still together. Okay, how did you get 5 Rand 60? You said 8,960,000, which is this one here. You divide it by the number of shares here, then you get, which is 1.6 million. And once you do this, you get 5 Rand 60, which becomes your average price. In other words, when we repurchased shares here, remember, average price goes to note number 7, and this difference goes to note number 8. So when you're coming here, you're now saying the repurchase of shares is at 5 Rand 60. So if you then say your amount which is given, which is your 100,000 shares, which is repurchased, you multiply it by the amount of the average price, which is your 5 Rand 60. You are now going to say 100,000 multiplied by the 5 Rand 60. You're going to get 560,000 here. You're going to get 560,000. Okay. Now you are now able to get your missing amounts. Let's start getting your missing amounts. The first amount that you can get, you can either get the number or you can get the rand. Okay, so this is the number of shares and here is the rand. Let's start first with the number. If you want to get the number, you will do your calculation going up, and the sequence is when you go up you subtract, but when you go down you add. Okay, you go up, you subtract, but when you come down, you add. So you're going to say you 1.6 million here, and then you go up. So it's a minus, which becomes a plus. So it's going to be 1.6 million plus the 100,000. Are you still with me? And then minus the 1 million. And you're going to find that you're going to end up here with 700,000. You're going to end up with 700,000. How did we do that again? I'll repeat. It is your 1.6 million here. You're going up. When you go up, you say minus. So it's 1.6 minus a negative 100,000. A minus gives us a plus. So it's going to be 1.6 plus 100,000, which gives you 1.7 million. Minus the 1 million up here, it gives you 700,000. So it becomes easy now. When you have your 700,000, you multiply it by the 5 Rand, which is the issue price. So 700 multiplied by the 5 Rand, it should give you 3,500,000. As simple as that. All right. You don't need to stress much. So one advice that I want to give you guys is when you are given note number 7 and you are required to do it, it might seem at first that there is some missing information, yet there is not missing information. But what the examiner wants is for you to be able to do it at times from the bottom going up, doing it from the bottom going all the way up. I want you to see, here it is now. All right, neatly written. And here is very important information that number 1, the number of shares at the end of the year, remember, is your 1.6 million. Remember, we did calculate that. That is your 2 million multiplied by the 80%. We did do that one. Okay. And then the next aspect that I want you guys to take note of is very important, that if you are given the values at the end here, when you have the values at the end, it is easy for you now to calculate the average share price. That is what we did. We simply took our 8,960,000, we divided by the 1.6 million. You took this 2 and it gave us 5.60. Okay. And once you are repurchasing shares, that is what you use in your note number 7, the average price. Okay. Very important as well, that the number of shares issued for us to get the 700,000. What did we say? We said our 1.6 million plus the 100,000, because we are going up. When we go up, we say minus, but it's minus to a negative amount as well. That's why we added it. And then you will then subtract the 1 million. Others say do opposite of the signs. It is still correct. Okay. Now, I want us to go to the next aspect. The next aspect now has to do with your retained income, which is note number 8. So what we're given are balances. We're given balances already, and we have the opening balance, which is your 434,000. That is your opening balance. Let's see what else we were given. Okay, so I'm gonna use again, it's exactly the same information. So the balance here we're given is 434,000, and the net profit after tax is 850,000. And now we're going to deal with the repurchase of shares. So remember what the examiner told us earlier on, that we repurchased shares and the repurchase price was not given, but we were given the average price, or we calculated rather the average price. You still remember that one? Yes. And we got the average price to be our R5.60. Now let's hear what more do they say. They say 100,000 shares. So the shares that we repurchased here are 100,000. Okay. And already I know here I must have my brackets ready for me. My 100,000 shares, I must have my brackets ready for me. Now, they then told us that these shares were repurchased at 25% above the average share price, at 25% above the average share price. So it depends what is it that we want. In this particular case, we can start first by getting the repurchase, that we can get the difference, or we can just get the difference. It still gives us the same figure. Let's suppose we are going to get the difference first, or we can get rather the repurchase amount first. Let's go and calculate the repurchase amount. The repurchase amount, if you remember, we are told that we repurchased at 25%, above the average price. Are you still with me? So that simply means the repurchase price is going to be 100 plus the 25% above, which gives us 125. All right. So what we want is the 125 over what we have, which is the 100, and what we have is the R5.60. If you do this, it should give you 7 Rand. And when you come here now, it means here my repurchase price is 7 Rand. Okay, remember this is what we use when we prepare the cash flow statement, okay, under our financing activities, okay, on the repurchase of shares. But when we are here now, remember we're doing note number 8. What we use in note number 8 is the difference. The difference between what? Between the 7 Rand and the R5.60. So in other words, you're going to say 7 minus R5.60, and it gives you R1.40. So the R1.40 is the price above. Okay, that means I'm going to come here. I'm going to now say 100,000 multiplied by R1.40, which is your 1.4. 140. If I multiply that, it should then give me 140,000. This becomes your repurchase of shares, 140,000. Now, when we come now to our ordinary share dividends, remember, we have two. Number one, it is your paid, okay, your interim. Number two, it is your recommended, your declared, your final dividends. Okay. Now, in this particular question, they say on 31 April, dates are very important in this regard. Dates, very important, because with dates, we can ascertain to which number of shares are we giving the dividends. Okay, so you need to be very careful of dates. Okay, so you can see at the beginning, we're starting with 1 million. And after that, on the 31st of April, we're already declaring an interim dividend. And there was no new issue of shares. In other words, it's telling us already that when we are declaring or paying our interim dividends, we're paying them on this 1 million. Let's see what they said. Interim dividends paid 35 cents per share. Okay, so we come here, we're now going to say, these are my paid. To how many shares were they paid? 1 million. And then how many cents per share did we give? 35 cents. So we gave 35 cents per share. So if it's 1 million multiplied by 35 cents per share, it should give me my 350,000. Okay, this one was simple. You simply had to look at the dates. 1 March is the beginning of the financial year. How many shares were we having? 1 million. Was there any other new issue of shares? No, there wasn't. So what does that mean? We gave our interim dividends to the number of shares that we had at the beginning. Now, let's go to the final dividends. With the final dividends, remember now, there were new shares issued here. New shares issued here. Remember that one? New shares issued. And we now know how many shares were issued here. All right. We now know how many shares were issued. And then these new shares that were issued, remember, there were 700,000. Okay. Remember, there were 700,000 shares that were issued. Remember, we did do note number 7 just a while ago, 700,000. When we calculated going up, now you remember. Okay. So we had at the beginning 1 million, and then we issued new shares, which is 700,000 shares. And then on the 31st of January, it says 100,000 shares were repurchased. Okay. Now I want to quickly go where I want. It says these shares qualify for final dividend. In other words, the shares that we repurchased are going to get a final dividend. What does that mean? It means I'm giving to the 1 million, which I had at the beginning, plus the 700,000, which are issued. So I'm giving my final dividend to 1,700,000 shares. So I'm going to come here, it's 1.7 million. Okay. And then I'm going to multiply it. What are they getting? They're getting 10 cents per share. So I'm going to come here and multiply by 10 cents per share. It's 1.7 million multiplied by 10 cents per share. How much is that going to give me? It's going to give me 170,000. Okay. Yeah. It's as simple as that. Remember, this is only declared. And if I could just sneak in already here, that means this goes now to my current liabilities in the balance sheet. I'm going to touch it later. But when I get there, I want to remind you of what I'm saying now, that your final dividends, once you calculate them and they want you to do a balance sheet, already think current liabilities, shareholders for dividends, and you take it straight to your balance sheet. But in this case, I'm just showing you the notes. All right. So I'm going to add this to, how much do I get here now? I'm saying 350 plus my 170. That is going to give me my 520,000. Okay. 520,000. Remember, it has to be in brackets because we are taking it from our retained income balance and net profit after tax. And then once you are now going down, so you're going to say your 434,000 plus your 850,000 minus 140,000 minus the 520,000. When you do this, it should give us at the end 600,000. 624,000. Okay, 624,000. You see, we were getting the information and we were putting it. It is very important that you understand. Here is the key aspect. These shares qualify for final dividend. These shares qualify for final dividend. Okay, most of you make a mistake in the exam and then you exclude the shares repurchased, which is this 100,000. If you had issued the final dividend to 1.6 million, that would have been incorrect. Why? Because the shares repurchased, that 100,000, was getting the final dividend. Okay, let's see. Okay, this is here now, properly written. Okay, so you can see your balance at the beginning, your net profit, and this is the 140 that we got. Okay, and then your total of the interim and the final, and these are the figures, and we end up with our 624 down there. Okay, let's quickly rush. I would want to show you how it would then appear in a balance sheet, how it would appear in the balance sheet. So here's my note number 7, which is my 8,960,000. Remember, we got this. And then retained income, which is note number 8. Okay, 624,000. When you add these two, they will then give you a total of 9,584,000. 9,584,000, which is what we call our shareholders' equity. Now, when I talk of the shareholders' equity, already in your mind, you are thinking there should be financial indicators which relate to this, to the shareholders' equity, financial indicators which relate to this. And one of the financial indicators which relate to our shareholders' equity is the NAV. Okay, the NAV, net asset value per share. Okay, and the formula for the net asset value per share is your shareholders' equity, which is this figure here. You divide it by the number of shares in issue. Okay, then you multiply it by your 100 cents. It gives you the NAV. In other words, if we were to try it with this particular question, what would we be saying? Okay, you should take your 9,584,000 and then, okay, let's do it practically. So it will be your 9,584,000. You divide it by your number of shares in issue, 1.6 million. You multiply it by your 100 cents. Okay, I think it should give you somewhere around 599 cents. This is very important for what I will show you later in this presentation. Okay, so whenever you see your shareholders' equity, whenever I see your shareholders' equity, think NAV. Every time you see your shareholders' equity, please think of your NAV. I'm now going to go and do an extract from the NSC November 2021 question 1. Okay, so this is part of last year's final exam. It is very important that we go through this. It is a very interesting question, and I want you guys to stay put and please let's follow the calculations. The beginning part of the question does not come with a balance sheet, but you would understand already that normally when they bring the balance sheet, they made it with something else. It can be note number 3, note number 7, note number 8. They can made it with anything. In this particular question, they made it the balance sheet to the calculation of the correct net profit after tax. Okay, I've seen several questions like this. It is important that you understand how to do the calculation of correct net profit after tax. All right, now you will see that on the first one, I have an adjustment. And the adjustment reads, audit fees include 123,600. So in audit fees, we have 123,600. And that 123,600 is paid in advance for the next financial year. What does that mean? It means it is an expense which has been overstated. It is an expense that has been overstated. When an expense is overstated, it understates our profits. Get it? When an expense is overstated, it will affect our profit. In what way? It understates the profits. It reduces the profit. So what then do? We need to bring back our profit to where it was supposed to be, because our audit fees of 123, which was paid in advance, we were not supposed to pay them. Okay, but we paid them in advance and they are due for the next financial year. So if we're going to do this in the calculation of correct net profit, remember, it is an expense which has been overstated. And when an expense is overstated, it understates the profit. So you have to go and edit back. You have to edit back. So I'm going to come here and I'm now going to say, what is this? This is my audit fees. Okay, this is my audit fees. And my audit fees, when I come here, I have to add this back. And how much am I adding back? I'm adding my 123,600. It has to be added back. It has been subtracted when it was not supposed to be subtracted, because it's for the next financial year. So in this regard, I have to come and add it back. And then it is important that you understand that when we deal with an adjustment like this one, this is 123,600. It not only affects the income statement, but it also affects the balance sheet, because this is a prepaid expense. Okay, an expense which has been paid in advance. So in the income statement, I have shown how it must be recorded here. I must as well take it to the balance sheet. So if we pay an expense in advance, it should come to note number 5, that is trade and other receivables. And what do I now say? I'm going to put it under my prepaid expenses. Okay, under my prepaid expenses. All right, and then I'm just going to open a bracket and I'm going to bring here my 123,600. I've paid it in advance. Are we still together? It is important that when you do adjustments, especially when you know that a balance sheet is following later, don't do the correction of net profit in isolation and then you do the balance sheet in isolation. You will never finish the exam paper, but you need to do them at the same time, knowing that my adjustment affects the calculation of correct net profit as well as my balance sheet, so that when we get to the balance sheet, we're just putting in figures that we have already calculated. So here I have 2 adjustments in the income statement as well as in the statement of financial position. Okay, let's see here on my, if I'm to show the answer, there it is how it should appear. And then these expenses should be reduced, and then it should come under trade and other receivables, 123,600. Let me come to the next adjustment, a very interesting one. The next adjustment is an interesting adjustment. It has to do with a loan. It has to do with a loan. It says the repayments on the loan are fixed. Very important here now. Okay, the repayments on the loan are fixed at 35,000 per month, and this includes interest that is being capitalized. Okay, so what I tell my learners in my classes, the moment you hear interest is being capitalized, just open a loan account. Okay, just open a loan account. On your loan account, you treat it as a liability, which it is, and then on the credit side here, you are going to put a plus. On the debit side, you are now going to put a minus. Once you just hear the examiner saying that the interest is being capitalized, in one of the adjustments, you can do it in this particular way. And then let's now see balances as per the loan statement. I'm just going to copy the balances into my loan account. I'm going to come here. I'm going to have here my balance at the beginning. That is my balance brought down now. Okay, and how much did I have at the beginning? 4,175,000. There it is. 4,175,000. That is my opening balance. Let's see what else did they give me. They gave me the balance at the end, and the balance at the end is how much? 4,028,000. Okay, so I'm going to come here and I'm now going to say my balance at the end. I'm going to come here. It's going to be balance brought down. It is 4,000,000 428,000. Okay, so like that now. It's coming beneath my double lines here. You can see that. That means if it's BD here, I must then bring it here and say balance carried down, which is still my 4,028,000. This is very important. You need to know this format. Remember, it's coming from grade 10. In grade 11, you did it, and now we're just reinforcing it in grade 12. And then what did they say? They then said repayments are 35,000 per month. So in other words, I'm coming here and I'm going to have my repayments, which are 35,000 per month. And we know in a year, how many months do we have? 12. So it's going to be a 35,000 multiplied by the 12. How much do you get? Okay, thank you. We now get our 420,000. Okay, we get our 420,000. So we're going to look now. Remember, it's a ledger account. And you know how to close off a ledger account. How do you close it? The side with the highest amount. So you look for the side with the highest amount. It's definitely the debit. And you're going to say 420 plus 4,028. You're going to get your 4,448,000. So you're going to come here. It's 4,448,000. And then here, you're going to end up with your interest. And then if you say 4,448 minus 4,175,000, you get your interest of 273,000. That is how you get your interest in a ledger account. Okay, now, and one of the important things that you need to know later, even as you continue to do this, they said repayments include. So in other words, in the 420, we paid for two things. Number one, we paid for the interest. Number two, we paid for the loan itself. That is one thing that you also need to take note of. Okay, let's see. Here it is properly written. This is what we were looking for, the 273, which is our interest. Okay, now I want you to see how you would do it if you're using the bottom-up method. With the bottom-up method, remember, when you go up, what we agreed, when you go up, you subtract. When you go down, you add. So you're starting off with your 4,028,000. You're going to say 4,028,000 plus the 420 because you're going up. So it's a minus, plus 420. Then you say minus 4,175. That is how you get your 273. That is using your bottom-up method. Both methods are very correct. It depends which one suits you better. But I want to encourage you to stick to one method. You polish it up so that when the exam comes, you know one method which makes your life very easy. All right. And then let's now come and see how it would appear. Okay. When we are now preparing the correct net profit after tax, we are now going to come and say interest on loan. It is 273,000. You can see there we are recording 273,000. Why? Because interest will reduce our profit because we're talking about interest on loan. It is interest expense. And then the treatment of the balance sheet, I will do it when I am now busy with the balance sheet. So please stay put for the balance sheet. Now, here is adjustment number 3. Adjustment number 3 is now saying rent of 74,000 was received from a tenant for the period. It goes without saying. Audit fees, director's fees, insurance, rent. These are adjustments that the examiner will always bring. Okay, so you need to follow these adjustments. You need to practice as much as possible that you can be able to get marks. So here they're saying rent of 74,000 was received from a tenant for the period 1 July to 2020 August. So remember, our financial period is ending in June. Our financial period is ending in June. So they say that this has been recorded. So we have received some income in advance and it has been recorded. Then they say this amount takes into account a reduction. There was a reduction on the monthly rent by 750. Okay, normally we're used to the one whereby rent has increased, but in this case they're saying rent did not increase, but rather it was reduced by 750 per month on the 1st of May. Very important, you need to know your dates. The adjustments have not been made. In other words, they want us to do adjustments for them. Let's see if we can assist them. Now, rent has been reduced by how much? 750. Here's my 750. Okay. For how many months has it been reduced? Now you need to count literally. So you're counting from what? June is the last month of the financial period. So you're going to count from what? From the time the rent was increased until June. Then you consider that it went beyond June. Okay. So take into account a reduction of 750 per month on 1 May. So we're counting from May. We're going to say May, June. Okay, the financial year ends. Then we go to July, as you see here, and also August. Are we together? Okay, this is the period where it begins. Okay, this is the period where it begins, and this is where we paid until the end. So again, we're counting from May, June, July, and then August. So we paid in advance for 4 months. We received rather in advance for 4 months. Rent was received in advance for 4 months. Okay, so if rent was received in advance for 4 months, it is 750 per month multiplied by the 4 months which we have received. Okay, then we're now going to say how much is the total decrease. So it's 750 by 4, which gives you your 3,000. We want to see if rent had not decreased. If rent had not decreased, how much would have been added to that particular amount? So we're going to come now and say the 74,000, which is rent for some months which were constant and the rent for other months which were decreased. Let's add back the decrease. And then we're going to come and add the decrease of 3,000. We're adding the decrease of 3,000. All right. And then you can end up now with 77,000. What is 77,000? 77,000 is now rent for 14 months without any decrease. Very important. It is 77,000, the rent for all the months, that is the 12 plus the extra 2, 14 months, but without any decrease when rent is constant. So we're going to come here and we're now going to say my 77,000 divided now by 14. If I divide it by 14, I'm now going to find that rent per month before decrease was 5,500. That is what rent would be before any decrease, 5,500. But we are told that rent decreased. That means I need to come here and I need to say rent has decreased by how much? Rent has decreased by 750 per month. So it's 5.5 minus 750, and it gives me 4,750. This is rent per month after decrease now. Okay, let me do it again. 77,000 rent for 14 months without any change, divided by 14 gives you 5.5 rent per month without any change. But we know that the 2 months that we received in advance had a decrease. So we need to come and decrease by 750. Once we subtract 750, we now have rent after a decrease, which is 4,750, what you have here. And our problem is how many months? 2 months. Okay, because the financial year ends, it starts from July, it should end in June, but we received until August. In other words, there's July and August in there. Then you multiply by the 2 months that we have received in advance. So it's 4,750 multiplied by 2, and it will then give me 9,500. 9,500 is my income received in advance. When I have income received in advance, I should adjust it to the income statement as well as to the balance sheet. Okay, in the income statement, what are we saying? Remember that this is income that we received and it was recorded. In other words, it overstated our income. When income was overstated, profits were also overstated. Get that? This is rent income. When you receive more income your income for the year was overstated. Once income is overstated, your profit at the end of the year was overstated. That means we must come here and subtract. So I'm going to come here and I'm going to say rent, and I'm going to now subtract 9,500. Why am I subtracting? Because we recorded income that was received in advance, which overstated our income for the year. Hence, our profit was also overstated. To be realistic, let's go subtract it because it is income for the next financial period. All right. And then you would realize that when we are doing the balance sheet, remember, it's income received in advance. In the balance sheet, you take it to trade and other payables, which is your note number 9. So I'm coming here to say plus 9,500. We have received some income in advance. Okay, let's quickly go to see how it would appear. Neatly written. There it is. Okay, and then rent received in advance will be deducted. Rent received in advance will be deducted, and it should come to your trade and other payables. Okay. Let's see the next adjustment, which I believe should be the last adjustment in this regard. It says, so first they gave us the list of balances before taking into account the adjustment. So we have SARS, income tax, provisional payments of 1.2 million. Then they say, after taking into account the corrections above, it was determined that an additional 85,250 is still owed. Still owed. Okay? An additional 85,250 is still owed. In other words, apart from the provisional tax payments we have made, we are still owing. What does that tell us? Our tax assessment for the year is higher than what we have paid them as provisional tax payments. So when I'm doing now my calculation of correct net profit, I'm going to come and what do I say now? I'm going to now say income tax. Okay, I'm going to say here's my SARS income tax. I'm going to say my SARS income tax. I have so far paid 1.2 million, but they tell me I still owe 85,250. That means I must come and add 85,250. I must add it. That means at the end of the year, I must get 1,285,000, okay, 250 as my income tax in the income statement, because 85,250 is still owed. All right, but remember what I taught you. 85,250 is my adjustment. It should go to the income statement as well as the balance sheet. In the income statement, here we have it. In the balance sheet, once it is owed, it goes to your note number 9, to another payables. So I'm going to come here. I'm going to say SARS income tax. It should appear here. Are we together? Under to another payables. If there were figures already, I should come and say plus 85 rather, 250. 85, 250. Or if you're given space, you could have shown it separately as well. You're going to see when we do the balance sheet that some items, when space is provided, you can show them separately. Okay, so here is our adjustment, properly written. Remember, the 1,285,250 is a combination of the 1.2 million plus the 85,250. That is how you get this one here, which is given up there. Very important that you understand that if it's still owing, you have to come and add it. And once it's owing, it comes to your trade and other payables. You are still to pay it over to SARS. Now, here is your final answer at the end. When you're completed, you should be having your 123,000, which is audit fees here, and then your interest on loan. Remember, we subtracted, and then your rent income, and then your income tax. Remember what we've just done here, and then you should end up now with the net profit after tax of 3,474,800. Beautiful. Okay, now I want us now to jump straight into the balance sheet. Okay, so on information B, it says the accountant omitted the following, or the closing stock figure of a formal suits in the trading stock balance provided in information A. Okay, and then it says, note, the first in, first out method is used to calculate the value of the stock of formal suits. All other entries have been recorded correctly. I know you have not done this method. You are only going to do it later during the term. That is your inventory valuation. But because this link, you're going to watch this lesson until you write your final exams. So I am just going to quickly show you in less than a minute how the FIFO method works. I know you haven't done it, so don't crack your head. FIFO simply stands for first in, first out. What does that mean? Whatever stock we receive first is what we sell. So here they want us to calculate the value of closing stock. I'm just going to get quickly to that and not take you any further. So we are to give value to these 240 units. That's what they want. We are to give value to those 240 units. This is what the examiner wants. But if we're to give value to those 240,000 units, we have to consider that whatever came in last is what we'll sell last. So we look at the purchases right here at the bottom here, Okay, and the last purchases were 230. That is what you see there. But on that 230, we have returned 24 back to the supplier. So it will be 230 subtract 24. Okay, as simple as that. So 230 subtract 24, how much do you get? You get 206. That means I'm going to have my 206 here. I'm not dividing here. I'm not saying 206 divided by 240. No, I'm simply building. I'm starting from the bottom going up. Okay, I need to make 240 units. But what do I get? First, I get my 206. And this 206, what was its value? It was 2,850. And then if you come here, you're going to multiply that. It gives you 587,100. Okay, it's as simple as that. Just take from the bottom. Don't stress about it. You're going to do it nicely. And then remember, you have 240, but you only got 206. How many more units do you still need? You need 34. So you're going to just say 34 on top there. And then you look in the next month after May. The next month after May is what? Feb. In Feb, how many do you have? 270, but we only need 34. So you get your 34, and then you say multiplied by the cost, which is 2,600. And then how much is it going to give us? It gives us 88,400. And when you add this two, it should give you 675,500. That becomes the value of closing stock. Remember, it's a topic that is still going to be introduced to you. So you do not need to stress much about it. But if you're quick, already you got what I was saying. It's the first in, first out method. So you just start from your bottom. Your closing stock is 240, but you're building from the bottom going up. So if you need 240, what is the first month? The last month rather, it is your May. But in May, you can't get 230 because you returned 24. So you only have 206. Then you still need to get 240. So you take the 36 in the next month, which is Feb here. You multiply them by their individual unit price, and then you land yourself here with 675,500. So when we come now to our current assets, when we are talking about our inventories, you would understand that in the list of balances, we had already an amount which was there, which was 4,198,500. It was already given. Then you're just going to add, because they said it was omitted. So you're going to come and add your 675,500. That is what you're just going to do. I'm not going to close the bracket now because there's still more information we need to consider. Okay, so this is adjustment B. Okay. The next adjustment, remember I told you that the balance sheet is made with so many things. We just saw now inventory coming in. And here now we have something else. Here we have our information which has to do with shares. Let's see what they want us to do. It says shares and dividends. 26,000 shares were repurchased on 1 July 2020 at 3 Rand above the average price. The business did not pay interim dividends during the 2021 financial year. A final dividend of 65 cents per share was declared on 30 June 2021, and 1,800,000 shares were in issue on 30 June. And then they give us something here. What do they give us? They give us the acid test ratio, and then they give us the NAV. So if you look at these two financial indicators, you then think, if I am on the balance sheet part and I'm looking at my shareholders' equity as well as my current liabilities, okay? In this case, don't consider current liabilities, but only the shareholders' equity. If I'm in the balance sheet and I'm looking at my shareholders' equity, which of these two financial indicators should I bring into gear? Okay, which one should I engage? It will not be the asset test ratio. It will definitely be the NAV. Remember what I taught you earlier on. Whenever you see shareholders' equity, you must think net asset value. Okay, now remember now, our shareholders' equity is made up of two things. Remember, note number 7 as well as note number 8. What is note number 7? Your note number 7 is your ordinary share capital. So I'm going to say here, ordinary share capital. Okay? And then, what else? Now, the problem is, when we come to 2020, there's nothing here. We come to 2021, there's nothing as well. Could it mean that the examiner made a mistake? I don't think so. They want us to figure it out. Let's see the next one. You have your retained income. So I'm going to come again here and I'm going to say retained income. Okay? And on my retained income, they gave me the retained income at the end, which is this one now, 3,240,000. So I'm going to come here. My retained income is 3,240,000. That's my retained income. Okay? But now I'm sitting with about two unknowns. This one is unknown, this one is unknown, and this one as well is unknown. So I need to figure out one of them. Let's see which one we can figure out. That means we need to bring in our NAV. NAV. If I'm to bring in the NAV, what does it help me to get? It helps me to get my shareholders' equity. Remember, what is the formula for NAV? It is shareholders' equity over the number of shares in issue multiplied by your 100 cents. So what did they give me? They gave me the number of shares in issue and the NAV. That should make my life very easy in this case. What should I do? It means if I come to my shareholders' equity, I should now simply say, how many shares do I have? 1,800,000 shares. And what is my NAV? 540 cents. Now, if you use it as 540 cents and forget to divide by 100, you're going to get a very huge amount. You're going to think you did something wrong. So I always tell my learners, whenever you come here, you should just use it as 5.4. The moment you just forget to divide the final amount by 100, you're going to get a figure that is going to cause you migraine immediately. So you just take in your 5.4. So when you come here, you are just going to say multiply by 5.4 multiplied by 5.4. Okay, you close your bracket. Okay, and then that should give you, check in your calculator, how much does it get? If you say 1,800,000 multiply by 540, punch in your calculator, how much do you get? Thank you. You should get 9,720,000. You get 9,720,000. So now we don't have much problems anymore because we have the total and one of the values, which is our retained income. We can now get our ordinary share capital. How do we get it? We simply say our 9,720,000 minus the 3,240,000. That should give us our ordinary share capital to be 6,480,000. 6,480,000. Very simple. Okay, so the moment you're given financial indicators, they're trying to tell you that some of the figures you need to get them through the financial indicators, as we have seen in this instance. Okay, come here. I want to show you the next adjustment. The next adjustment. It says, debtors with a credit balance totaling to 11,000 must be transferred to the creditors ledger. Debtors with credit balances. Let's see, what does that mean? If I am to draw my debtors control, debtors ledger, all right, remember the debtors control is a summary of the debtors ledger. So I'm just going to say debtors control or slash debtors ledger. So here's my plus and here's my minus. And here they're saying must be transferred to the creditors ledger. In other words, they are bringing in the aspect of the creditors ledger. So I'm just going to say creditors control as well. And here is a plus and here is a minus. Debtors with a credit balance. That means the balance is here, 11,000. Okay, so debtors must have a debit balance, assets. Debtors must have a debit balance, assets. When a debtor now has a credit balance, they're saying this debtor with a credit balance, we should now transfer him to the creditors ledger. So remember double entry principle. I have to have two entries that I have to make. That means if I'm to take this amount out from the credit side of the debtors ledger, I have to remain with zero in this account. I have to remain with zero. What do? I come and I record 11,000 here. Okay, remember the sign. What did I do? I came and I said plus 11,000 in the debtors control. So I'm coming here to my trade and other receivables. I'm going to say plus 11,000. Very important. I have 11,000 here. I need to write it off. In accounting, we don't write it off by coming to say, I have written you off. No, I record the amount on the opposite side. Therefore, the account becomes zero. So I had to come and record 11,000 here. What does that mean? I'm saying plus 11,000 in the debtors control, as you can see here, plus 11,000. Then to complete double entry, I have one account with a debit. I need another account with a credit. So I'm going to come now to my creditors control. I'm also going to credit now with 11,000 to complete double entry. One account debited, another account credited. What does that mean? I'm coming now to my current liabilities, trade and other payables. I'm going to say plus 11,000. There. Are we together? Okay. Don't fight so much with the signs. Just follow the simple instruction. Draw your debtors control, draw your creditors control. Then put the signs on the right side and then simply transfer it. Now, I want us to come to the next one. The next one. It says here, on 30 June 2021, Jimo Limited returned 10 ladies' coats to the supplier. So we returned 10 coats to the supplier, who is bargain wholesalers. The selling price was 1,750 each. Okay, so we're returning 10 and each one is 1,750 each. So it means here it's 1,750 multiplied by 10, which should give me my 17,500. Okay, and then the markup was 25% on cost. Already, this is grade 10, that cost is always at 100, and then markup in this particular case is 25. Therefore, selling price becomes 125. And what I'm given is the selling price, which is 17.5. So what do I need? They then say the markup was 25. No entry has been made. So we have returned goods, but we were given them at the selling price. So we had to come back to its cost price. It simply means you need to use the UK method. What does it say? It says what you want over what you have multiplied by what you have will give you what you want. So what we want is the cost, which is 100. So what we want is 100. Is still following? What we have, your have must have two values. So this is one value, two value. So what we have is 125. and multiply by the have rent value, which is 17,500. Once you do it like this, you should end up now with 14,000, which is the value, the cost of the goods returned. Okay, the cost of the goods returned. Once you get the cost of the goods returned, you should now come and adjust it. All right. So we're coming now to our trading inventory. In our inventory, we're going to come and say minus. Okay, remember it's part of trading inventory. And when it's part of trading inventory, you must come and subtract it. So you're coming to say that those goods are not with us anymore, minus 14,000. And because we have returned them to the supplier, that means our creditors are also going to go down. Then we're going to say minus 14,000. Okay, so we are decreasing our creditors at the same time, minus 14,000. Okay, please take note. Inventory, we have returned the goods, we subtract 14,000, and we have returned the goods to the supplier. That means our creditors have decreased. So we go to trade and other payables, then we say minus 14,000 as well. Okay, I want us to quickly come now to the next adjustment, a very interesting one. It says the loan, mortgage loan from Best Bank. So it gives us the 2020 balance as well as the 2021 balance. All right. And then the repayments on the loan are fixed. Very important. They are fixed at 35,000, including interest. So here we're given the balance as of the loan statement, which is your 4,028,000. This is the closing balance from the loan statement, 4,028,000. That means if I'm to come to my balance sheet, I'm just going to say my mortgage loan. I'm going to come here and say my mortgage loan is how much here? It is 4,028,000. But what I'm picking up here is we still are going to make fixed installments of 35,000 to cover the repayment. And interest has to be paid over the full period of the loan. Interest will decline over the life of the loan. The interest on the loan for the budgeted period is going to be 234. So they're saying interest in the next financial period is going to be 234. But however, we're going to continue paying 35,000 per month. Our fixed monthly installments will remain fixed as they are. What does that mean? That means if I take my 35,000, which is my monthly repayment, I multiply by 12, which is the months in a financial year, I'm now going to get how much? 420,000. This is what I'm paying annually. But in this payment, it includes two things. Okay, it includes my interest and my loan. They're now telling me that of this 420, interest is going to be 234,000. Interest is going to be 234,000. So if I say what I am going to pay, subtract what the interest is going to be, how much is going to be my loan repayment. That means my loan repayment is going to be 186,000. 186,000. This is what it is going to be here. Now, this is for the next financial period. Remember, this is for the next financial period. So what it means is, in the next financial period, I'm going to be paying 186,000 off the loan as short-term loan. Short-term loan, 186. That means I'm going to come here and I'm going to say 4,028,000 minus 186,000. Minus 186,000. If I close my bracket here, I'm going to get my 3,842,000. But remember that this 186 must be brought down now to what? To my current portion of loan. It must come now to my current portion of loan, which is how much? 186,000. It comes to my current portion of loan, 186,000. Okay, very important. You did not have to open a T account for this one. There was no need for a ledger account. You simply to understand the saying, this is the balance of the loan at the end. And then we're going to continue paying 35,000, 35 multiplied by 12. That means we're going to be paying 420. Of that 420, the interest on the loan, we are expecting it to be 234. So we subtract 234. That means 186 goes to the loan repayment. There it is, as short-term loan. Okay, I would want us now to come to the exciting part of the balance sheet, closing it up, wrapping it up. Okay, we just now tacking up all the loose ends. We're now saying, what is it that I have not done? Then we still see we have a financial indicator we have not touched. Which one is it now? Asset test ratio. Okay, the asset test ratio is a very interesting financial indicator because it works hand in hand with its closest cousin, which is the current ratio. Okay, what is the formula then for the asset test ratio? The asset test ratio, the formula is your current assets minus your inventories, as to your current liabilities. Okay, cool. So here we're given our current assets. This was given in the answer book. This was given. So we are going to say 8.7 million subtract 4,860,000 as to X. We don't know our current liabilities. So we create an unknown for it. In this case, my apologies, I'm going to use X. And then the answer then is, let me try to break it down. If I say this minus that, I'm now going to get 3,840,000 as to X is equal to 1,2 as to 1. Okay, so you cross multiply. In other words, you're simply saying for you to get X, divide these two values. So simple as that. All right, for you to get X, just say 3,840,000 divided by 1.2. So if I'm going to get my current liabilities, which is X, I'm now going to say 3,840,000. Okay, then I'm going to divide it by 1.2. I divide it by 1.2. It should give me 3.2 million, 3,200,000. Okay, that then, if you have your calculator with you, you simply then say, you're punching in now. You have your 3.2 million on your calculator. Now say 3.2 minus 1,259,500. Okay, minus 1,170,000. You still with me? Minus 186,000. Lastly, minus 85,250. Remember, we dealt with all of these ones. And that was our shareholders for dividends. It should then give you your bank overdraft, which is 499,250. 499,250. Now, I want us to come back now here. And we need to complete our current assets. This is easy now because you have the total. You're given the total here, which is 8.7. So, and you have one value, two value, you're only missing this one. So in other words, if you say 8.7 million minus the 4,860,000 minus the 3,811,410, it should give you 28,590. That becomes your cash and cash equivalents. In this case, the balancing figure. Okay, let's see now how it would appear in the equity and liability section. Remember, we did do these aspects. We did do this one. Okay, so we have our total here. And then we came to our loan. Remember, we subtracted the short-term loan. And then we are left with that mortgage loan there. And then that current portion of loan is the one appearing down here now. You see that one there. Okay, then that is your short-term loan. And then I am now going to come and talk about your current liabilities. Remember, we calculated it using the asset test ratio. Okay, so that is how you get your 3.2. Okay, and then the SARS, we dealt with it. That is what was still owing, shareholders for dividends, our final dividends. Now, you are now going to say your shareholders equity plus your non-current liabilities plus your current liabilities, and then it should give you your total equity and liabilities. In this case, it is going to be your 16,762,000. And This should be the same as your total assets, 16,762,000, because we have already got this aspect here. Now, let's see how it would appear now when it's all brought together. Beautiful and wonderful. Here's our assets section, and here is our equity and liabilities. And these two must be the same. That is for us to say the balance sheet has balanced. Just as its name, it has to balance. Okay, it is important that you open brackets, guys. It is important that you open brackets. Very important that you know the format of the balance sheet. In my class, I tell my learners, close your eyes. Let's begin to say the format of the balance sheet. Once you can say it with your eyes closed, it stays in your fingertips. It is all possible. More practice and remain positive. Now, we've come to the end of our lesson today, my dear learners, and I want to thank you so much for joining us. It is very important that you continue calculating, working. You put more time to your accounting lesson, you will definitely get the best results at the end of the day. Thank you so much for joining us today. Once again, my name is Mr. Simbi. Hope to see you again. Cheers, take care, and goodbye.